It's been incredibly stable after the FTX related fall off last year. And by many of our metrics, and we will be putting out the Bitcoin Monthly early next week, by many of our metrics, there is outright capitulation all over the place. David Puel, who is our on-chain analytics expert, has a lot of capitulation metrics, and I think every one of them is where it has always bottomed before a turn. Now, we do have the digital currency group drama around Genesis, so we're watching that, and that probably, my guess would be the last shoe to drop if it drops, if they're unable to find their way out of this liquidity crisis. But in the face of that uncertainty, it is very interesting to see the Bitcoin price, for example, more stable in the last quarter than equities and bonds. And I think the other thing to note from bonds, if you adjust bonds for inflation, we have never seen a bigger rout. You have to go back to the 1700s to see a bigger rout than we've just been through.
Undoubtedly, 2022 was one of the worst years for Bitcoin buyers, primarily because the asset's price dropped by 65%. While there were some explicit reasons for the drop, such as Luna UST crash in May and the FTX implosion in November, the most important reason was the US Federal Reserve policy of tapering and raising interest rates. Hello and welcome to Money Talks. In today's video, Cathie Wood, CEO of ARK Investment Management, updates about the recession fears and the current market cap of the crypto industry and reaffirms her firm belief in disruptive innovation.
We did get, throughout the year, incredible turmoil around Luna, Terra, Celsius, 3AC, FTX, and so forth, and a really big black eye. But if you look at what caused the black eye, it was not Bitcoin or Ethereum. Those blockchains didn't skip a beat, didn't miss one transaction. And what we saw were the centralized entities touching crypto, FTX, 3AC, Celsius, other hedge funds, imploding. Why? They're centralized, not transparent, and there's no liquidity in them. Whereas if you look at what happened on Ethereum, the smart contracts, as trouble was looming, smart contract related margin calls, they were satisfied. Boom, boom, boom. No questions asked, no legal haggles. It just worked. And I think that will be the lesson coming out of this. And it is very interesting to note that Sam Bankman-Fried didn't like Bitcoin. And he didn't like it, I may have said this last month, he didn't like it because it's decentralized, fully transparent, and he couldn't control it. He considered himself the master of the crypto universe, which of course, the market has disabused him and others of.
Bitcoin's price had dropped 50% from its peak to lows of $33,100 before the Luna UST crash, thanks to the Fed rate hikes. The first significant drop in Bitcoin's price was due to growing market uncertainty around potential rate hike rumors in November 2021. By January 2022, the stock market had already started showing cracks due to the increasing pressure of imminent tapering, which also negatively impacted crypto prices. Fast forward a year and the crypto market continues to face the same problem, where the headwinds from the Fed rate hikes have restricted substantial bullish moves. The worst part is that this regime may last much longer than the market participants expect.
On February 1st, we'll probably see another 25 or 50 basis points. So we will be at 4.75 or 5%. Now, most of the Fed governors are saying roughly 5%, maybe a little bit more, and then we're done. Maybe the Fed will start talking a little bit more about some of the very significant declines in inflation and outright prices that we have begun to see. And again, we'll go into that in a moment. Those who think the economy is booming, the unemployment rate dropped from 3.7%, which was revised to 3.6, to 3.5, so back to the cycle lows. Non-farm payroll employment looked stronger than expected. I think 223,200 was expected, but previous months were revised down. So that was interesting. The other measure of employment that I've mentioned on this video a number of times is the household measure of employment. Now, it had been falling on balance since March of last year. And in December, there was a big burst, 781,000. Now, this incorporates more small businesses into the survey. So 1 month does not a trend make. It does not erase at all the gap between non-farm payroll employment and household employment that has built up since last March. There's a 2 million person gap. So the truth is probably somewhere in between.
The dot-com bubble of 1999 to 2000 could teach investors a lot about the current crypto winter, and it continues to paint a grim picture for 2023. The tech-heavy NASDAQ composite inflated to enormous levels by the early 2000s, and this bubble burst when the Fed began raising interest rates in 1999 and 2000. As credit became more expensive, the amount of easy money shrank in the market, causing the NASDAQ to drop from its peak by 77%. The crypto market is currently facing the same scenario.
Most important to me in this report, besides the fact that there was that pop in household, so employment isn't falling off a cliff, but the work week did fall 0.3%. And that is going to have an impact on incomes. It looks like personal income or personal disposable income will be up only 0.1% month to month when you take all these factors into account. That's not very much. We had better hope that inflation continues to slow. Most of the inflation indicators we've gotten in the last 2 months have been better than expected. And the Fed's beginning to mention that, but isn't buying into it yet. So we're in a period, we think, where average hourly earnings on a year-over-year basis are still falling in the 2.5% to 3% range in real terms, taking account of inflation. He has been stronger than expected. One of the major reasons for it is a collapse in imports relative to exports. So imports subtract from GDP. So if their imports dropped 8%, so if you subtract that, you're really adding to GDP. What is this saying? This is saying that we are cutting back on inventories. Much of them coming from China. I think in the import report, consumer was the biggest fall off, and that would be associated with China. Exports fell, but not as much as imports, and therefore the trade balance improved, and that's going to help economic activity. But it's not for a very good reason. If you think about this, exports down 8%. That's not year over year. That's a month to month. That's like 100% annualized percent decline, almost. Well, that's an exaggeration, but almost. So that's a very big drop and a big hit to China and other economies, I would suggest.
The crypto market needs the realm of easy money to return to build a substantial bull run. However, based on the Fed's current plan, those conditions look far away into the future. Only a black swan event that forces the US government to resort to quantitative easing with low interest rates and economic stimulus like it did during COVID-19 pandemic can ignite another bull run. To date, the total crypto market capitalization has declined by 75% from its peak of $3 trillion. The 2017 peak of around $750 billion is a crucial support and resistance level for the market. If this level breaks, the industry's total market capitalization could slip below $500 billion. While there could be temporary bear market rallies, the macroeconomic pressures are likely to undermine all positive moves.
Consumer services, of course, we have the Facebooks and the Netflix being disrupted. TikTok's a big disruptor. They're also now much more hostage to the cycle. Advertising is one of the first line items cut during a recession. And this is why we think we started in a recession early last year, because advertising fell off a cliff. And that is at least a coincident indicator, if not a leading indicator. So they're being disrupted. Now, in other innovation portfolios, true innovation portfolios, the new innovation, those stocks had a very bad year for a different reason. They're not being disrupted. In fact, they are more often than not the disruptors. They were penalized because they're investing aggressively now. And they are doing so because the opportunities associated with the 5 major innovation platforms around which we've centered our research. So once again, multi-omics sequencing, robotics, energy storage, artificial intelligence, and blockchain technologies, they are ready for prime time. They are taking off, as I'm going to describe to you in a moment. But the winners are going to be those companies that are spending aggressively now, especially because with artificial intelligence, many winners are going to be in winner-take-most categories. Asian investors look like they have 2 left feet, or that they've lost their brains. But we are more convinced than ever that these innovation platforms are evolving maybe faster than even we expected. And we believe staying away from innovation now is going to be as big a mistake as falling all over other investors to try and up technology weightings in the late 90s.
So, do you think it is a good time to invest in crypto? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.